Welcome to today's Market Explainer. We're breaking down a highly technical, macro-driven setup on the British pound against the New Zealand dollar, or GBPNZD. We'll be applying institutional order flow analysis and smart money concepts to really dissect the current price action across multiple timeframes. Let's step away from the retail noise, dive right into the data, and see exactly where the smart money is positioning.
GBPNZD is approaching a major liquidity zone, and smart money may already be positioning ahead of the next expansion move. While retail traders are currently trapped trying to catch a falling knife, institutions are just patiently waiting for the inevitable sweep of liquidity. Our objective today is to align our execution with these massive capital flows. We're stripping away the noise to focus purely on structure, mitigation, and high-probability order blocks.
So, to really understand the macro positioning, we first need to look at the Legacy Commitment of Traders, or COT report, for the British pound, and the data here reveals a pure bearish sentiment. Take a look at the non-commercial category. These are your large speculators, your hedge funds. They're currently holding roughly 68,000 long contracts against a massive 132,000 short contracts. That gives us a net position of negative 64,307, and it doesn't stop there. In just the latest weekly change, they dumped over 11,000 longs and stacked nearly 10,000 fresh shorts. This is a clear, institutional scale bet against the pound. Now let's connect that to the fundamental catalysts driving this capital flow. Looking at the economic calendar, we have a stark divergence. Over on the New Zealand side, the ANZ business confidence figure printed a massive jump, hitting positive 10.0, up from negative 10.6. That's a significant bullish injection, and it reinforces a hawkish stance from the Reserve Bank of New Zealand. On the flip side, the British pound is facing a critical event today at 3:20 p.m., a speech by Bank of England Governor Bailey. Given the heavy short positioning we just saw in the COT data, it looks like smart money is front-run this event. They're anticipating dovish remarks, likely driven by cooling inflation and a softening UK economy.
This fundamental divergence translates directly into real-world relative performance. When we look at the one-week relative performance against the US dollar, the narrative is pretty undeniable. The New Zealand dollar is dominating the board. Up 1.78%, it is the strongest currency in the market right now, hands down. The British pound, however, is trailing weakly at just positive 0.16%. The actual capital flow here is clear. Money is heavily rotating into the QE and actively avoiding the pound.
So, what does this all mean for us? Institutional trading relies heavily on macro convergence. When you pair a fundamentally weak currency like the pound with a robust, fundamentally strong currency like the New Zealand dollar, you create an environment for high-probability, sustained bearish order flow. The fundamental catalysts align perfectly with the institutional sentiment we've tracked, setting the stage for a strong, structural short bias on GBPNZD. Let's move over to the charts and see how this builds our technical premise. We'll start with the 4-hour time frame. The structure here is unmistakably bearish. We're witnessing a classic waterfall drop. Notice the aggressive breaks of structure as price just slices right through historical support levels. The fast EMA has crossed below the slow EMA and the spread between them is widening. This indicates absolute control by the sellers. There is zero bullish structural confirmation here. This is a market currently dominated by relentless institutional selling pressure. Zooming into the 1-hour time frame, we can see the anatomy of this momentum. The price action is heavily overextended right now. It's deviated significantly from the moving averages, and the 14-period RSI is severely oversold at 21.88. The MACD histogram also confirms this deep negative momentum. But keep in mind, an oversold market is not a signal to buy. Instead, we want to look for the origin of this displacement, the major institutional supply zone. The order block that actually initiated this current leg down sits up around the 2.2750 level. Dropping further into the 15-minute time frame allows us to refine that area of interest even more. Here, we can pinpoint a newly formed institutional supply base, nested right between 2.26450 and 2.26650. This zone aligns beautifully with the dynamic resistance of the 1-hour moving averages. This specific area represents the premium pricing tier we need for a mitigation block. Essentially, we're looking for price to return to this zone, to balance the current inefficiency before the next major downward expansion. Now let me be absolutely clear about this. There is no trade at current prices. No valid buy setup exists against this massive macroeconomic momentum. And selling directly at the current bottom near 2.25863, that's just retail gambling. The market is exhausted, liquidity rests above us, and we are hours away from a major central bank speech. Entering a market order now exposes you to a devastating pre-news short squeeze. So we wait for smart money confirmation. Patience is the absolute hallmark of professional trading.
Here is our highly calculated institutional trade setup. We're establishing a sell limit scenario based on a premium mitigation. Our entry is mapped at exactly 2.26650, which sits squarely within that M15 supply base we just identified. The stop loss is placed precisely at 2.27150. That positions it safely above the short-term structural highs to absorb any localized volatility. Take profit 1 is set to sweep the current lows at 2.2560, yielding a solid 1 to 2.1 risk reward. Take profit 2 extends further down to 2.2450, anticipating further macro-driven downside, which offers a maximum risk reward of 1 to 4.3.
To execute this properly, we must anticipate the news-driven liquidity sweep. Here is the protocol. Step 1, we wait for the 3:20 p.m. Bank of England volatility spike. We actually want Governor Bailey's speech to trigger an inducement move upwards. Step 2, we observe price mitigating our premium zone at 2.26650. And step 3, we do not blindly trust the limit order. We drop back to the 15-minute chart and wait for visual confirmation. We want to see a sharp bearish pin bar rejecting the zone, or a strong bearish engulfing candle. That price action is the footprint of institutions aggressively defending their short positions.
As professionals, we always define our risk before entering the market, so this setup has strict invalidation criteria. The trade is completely canceled if price just continues to bleed downwards and drops below the 2.2500 level without first retracing to our entry zone. In that scenario, the structural math simply no longer supports our risk profile. Furthermore, the setup is invalidated if a bullish Marubozu candle closes firmly and confidently above 2.27200. That would signal a genuine change of character rather than just a simple liquidity sweep. That concludes our structural explainer of the GBPNZD order flow. If you appreciate this level of institutional-style market analysis using smart money concepts and ICT methodology, ensure you're positioned to capitalize on these setups. To follow future trading opportunities and access detailed, unemotional market breakdowns, you can open your trading account using the link in the pinned comment. Stay disciplined, trust the structure, and manage your risk. The smart money is setting the trap right now. The only question left is, will you provide the liquidity or will you ride the expansion?